With me is a very exciting guest, Ariel Navarro, CEO of Well Capital. Nice to have you, Ariel.
I started 26 years ago in year 2000. The first interview that I had was with Banco Santander. We were putting together a team. I was employee number 7 of a business that went to be Allfunds. I think it's probably the largest mutual fund platform in Europe. Right now, what we do is to give exposure to digital assets in a controlled way to our investors. 70, 80, or maybe I've been generous, 95% of the tokens are going to disappear. If you invest into those protocols, you will want to navigate the cycle, right? And in order to do that, you need to develop algorithms. And that's what we've been doing for the last years, building all these algorithms that help us to identify trends and to identify markets, right? To be able to navigate them.
Let's talk about tech. Let's talk about tech. Let's talk about tech, baby.
Welcome to Let's Talk About Tech, provided to you by Venionaire Capital, the entrepreneurial partner for venture capital and private equity. Today, we are again live at Vienna Blockchain Week, and with me is a very exciting guest, Ariel Navarro, CEO of Well Capital. Nice to have you, Ariel.
Thank you so much, Philipp. Thanks for having me. Very exciting, and congratulations on the show.
Oh, thank you.
Congratulations on what you guys doing.
Yes,
With
thank
the
you so
funds
much.
and all the activity that you have, and congratulations on Vienna Blockchain because it's been a fantastic event.
Oh, yeah. I mean, we are a proud partner, and congratulations to you for your panel, obviously, that you had. We will speak about this a bit
Absolutely.
later. But Ariel, your background is deeply rooted into traditional finance. Banco Santander, Citibank across New York, Hong Kong, and Seoul also. So what originally pulled you into the digital asset space? So let us dive deep into your background.
Fantastic. Well, again, thanks so much for having me. Well, I started, probably a long time ago, 26 years ago in year 2000, right? And when I finished university, I never thought I was going to go into banking. It was the one thing that I didn't want to do, right? The first interview that I had was with Banco Santander, and I like people. And I think this is a very important thing in life, right? Liking people, work with people that you like, not just following, always money. It's important money, but it's important to work with people that you do like.
Yes.
And it's probably the most important thing, I would say, right? And that's probably how you guys invest. You guys invest in people, right?
Yes,
Don't
of course.
just in businesses.
I mean, as I said, our slogan is entrepreneurial partners. So we're trying to focus heavily on that. But of course, sorry for interrupting.
No, not at all. So really like the people there, and it just happened that I was very young. They were putting together a team. I was employee number 7 of a business that went to be Allfunds, right? Allfunds, I think, is probably the largest mutual fund platform in Europe, right? It went IPO 4 years ago in Amsterdam for 12 billion. It's one of the largest wealth tech in the world. And it was a fantastic experience, right? I mean, I was there when nobody was talking about startups, when nobody was talking about funders, when nobody was talking about rounds, nobody was talking about anything, right? The scale-ups, IPOs. I mean, it was something that we probably would listen from the US, Silicon Valley, but there wasn't anything in Europe, right? So that was a tremendous experience, really. And that is what took me to traditional finance, right? To traditional banking. And I just love it. I just loved it. I loved I think finance is what is moving the world. Fortunately, unfortunately, money is what is moving the world, right? Be able to understand how money works and goes around the world is something that is of my interest. And it gives you an amazing perspective of politics, commerce, everything, right? And it has allowed me to do multiple things, and it has allowed me to travel to many places, as you mentioned, which is at the end of the day, what I wanted to do when I finished the university, right?
Yes.
Back all that time ago.
I mean, as I said, this global exposure is really rare, actually, the exposure into or across 3 very different financial markets. So how did working in Asia shape your reading of how how crypto adoption actually unfolds?
Yeah. Look, I think you're right. I mean, that your question is 2 components. The first one, Asia, right? Asia is a unique place in the world. In my mind, I think, I was lucky enough to work in the US for a global financial institution, for Citibank. I was able to work in Europe for another large financial institution. And Asia, to me, right? I mean, I went there just before the Lehman crisis. The Lehman crisis, I think, in Europe lasted for years, right? In the US, probably lasted for a few years. In Asia, the resilience that the market had, obviously, historically, they already have had other crises, and then ultimately, it's people, right? The mindset of people is very different from what we have here. The entrepreneurs that you probably get from Asia are very different from the ones that you get here. People in general, right? I think they see that upside in the geographic and the populations are very young, right? So there's still a lot to build, right? So it's very exciting. The second part of your question is crypto, right? How I actually ended up in digital assets. The big component of banking is operations. Moving money, moving derivatives, moving anything, right? It's about technology and operations, right? Banks are built on top of legacy systems, not just one, multiple, right? And as you are streamlining, right, many of those technologies, what I saw, right, and what I thought it was going to happen is that at some point there were not that many people that were able to be needed, and also that some of the banks were going to be made redundant, right? So they are, I mean, why you want to? I mean, you take an example, credit card, right? If you're a merchant, you want to be waiting for 2 days as a merchant, right, to be able to receive the money from somebody. Not really, right? And with multiple processes, right? Same for capital markets, where the clearing, it just takes you 2 days to clear money, right? Transfer is the same. So I started to look into fintech. And fintech, very exciting. Obviously, in Europe we have amazing companies, right? But I thought it was a market that was catered for less developed countries, right, where you actually have these gaps, right? Europe, it was a bit, in my mind, right, a bit more. It's just more built already. So that took me to blockchain, right? I mean, I was seeing blockchain as a way to streamline many of those processes, right? You name it, you remittances, payments, sending orders, and that what took me to blockchain, right? And I went to the rabbit hole and obviously started to learn about protocols, started to learn about technology, use cases, and so forth. We saw a need in the market. The need that we saw is that at that point, this I'm talking about 2021, we funded the fund. It was pretty much the crypto bro mentality, right? There wasn't anything, at least in Europe, there were very few institutions that were doing something institutional, right, with the right levels of risk management controls, right, and not just going for the quick back. And that's how we created the company, right, on the fund.
Yeah, well, that sounds like an amazing journey. And actually, seizing the opportunity, now you have found Well Capital. And what are you guys specifically building today?
Right now, what we're trying to do is to give exposure to digital assets in a controlled way and in a risk-adjusted basis to our investors, right? I think in order to do that, if you think about traditional investments, usually what you do is you do analysis in the companies, right? And fundamental analysis, right? To be able to determine the fair price. That's an approach that we have, right? And I still have, right? But it's such a nascent industry that many of the metrics that are used in traditional finance are not really useful in digital assets, right? So it's very difficult to determine what is the fair value of something that has just started, doesn't have any right. Also, the data, the information is not fully transparent always, right? So that can lead you to, and then obviously you have how some of these protocols are A, funded, B, how the money is used, right? So it doesn't really, like, the numbers don't tell the whole story, right? It's also what we found out is over the cycles is that the cycles are changing, right? And so the cycles are predictable. So for us, we don't give up on obviously investing in the protocols that we think are going to be the ones that are going to dominate this space, right, in the next 5 to 10 years, right? But we need to do that in a research basis, right? So to that extent, what we do and what we see is, look, if you buy and hold, maybe you buy now, and we've seen this in the last cycle, right? 70, 80, or maybe I've been generous, 95% of the tokens are going to disappear, right? Even 99, right? If you invest into those protocols, some of those protocols, you will want to navigate the cycle, right? And in order to do that, you can do it manually, right? You don't need human interaction. So what you need is to develop algorithms, right? And that's what we've been doing for the last few years, right? Trying to build all these algorithms that help us to identify trends and to identify markets, right? To be able to navigate them, right? So the idea always is, when we have two products, one is it's a trend setting, like in traditional finance, momentum, right? The strategy, obviously using our own proprietary data, right? That help us to identify the market regime, and then a BTC denominated strategy, right? A Bitcoin denominated strategy, because A is where there is a lot of investors already, right? That are holding those investments, right? They want to get yield on that, and also because it's probably for sure is the market that is the most developed, right? And you have more liquidity and instruments. You have derivatives, you have futures, you have options, right? And obviously spot, right? So that's what we're building, right? And that's our goal is to be able to offer a product that help investors to be exposed, right, in a safe way, right, but also being able to take advantage of the upside of the of the asset class.
So giving institutional investors exposure in the digital asset world, but still up until this point, a lot of institutional investors are cautious. They're not really. How do I say? They do not feel that comfortable yet to invest in digital assets. I mean, what are the biggest concerns you're actually hearing right now, and how do you deal with that?
As I said at the beginning, right, I think this is a very nascent asset class. If you would have taken, stocks back in the day, where you get back to probably the 20s and the 1920s, the last century, right? You see how new industries were moving the same way. I mean, the Nasdaq back in the days, I mean, it had kind of the same behavior, right? Obviously, then markets need to mature, right? And then there's a selection of the protocols or the companies that are going to be doing well or they're going to be doing bad, right? But for the time being, kind of everybody's rushing into it. The market is maturing right now. And I think we're in a different phase. That's positive, right? Now, institutional adoption, right? I think there's not a single answer for this. I think there's few things need to be met to be able for institutions, right, to be able to invest in this asset class. I think first and foremost, nobody's going to invest if there's not a clear regulatory framework. I think in Europe, we've been able to get that. I think we have the first step, which is MiCA, right? And I think it's probably the most advanced framework in the world. And there's going to be MiCA 2 that is going to be addressing some of the gaps that MiCA 1 had, right? So I think that's super positive. That gives confidence, right? That gives confidence in terms of custody, like custody, stable coins, so on and so forth. That's positive. I think also the players that get into the market, you have players these days like Coinbase, Binance, all these guys, right? Some of them are already public institutions, that obviously need to meet all the regulatory requirements that they need, and they always under control by either the regulators or the investors themselves, right? So that's good. Now, I think the one thing that we need to solve, right, is the behavior of people, right? The question that we always ask or get asked, right, is, well, the two questions that we always get asked is, how do you value these assets? Right? Because a lot of people are coming from the mindset of equity.
Yeah.
That's one. And the second one, it resembles to a casino, right? The answer to those two questions, it's the first one, which is a nascent asset class, right? So you will see casino behavior, absolutely.
Yeah.
That, it's come from greed, right? And the greed is coming. It's not just in crypto; it's coming anywhere. I mean, you probably see that we go back to 2021 when GameStop was happening, right? And
Yeah.
short the squeeze that all these guys were doing. That's part of it, right?
Yeah.
But as the market is maturing, right, we're gonna see protocols that start behaving like equity itself, right? And with that, I think the market is gonna be accepting some of the valuation tools that traditional finance has, right? I mean, it's obviously very difficult to do at DCF. How you're gonna be? What's interest rate that you're gonna be using,
Yeah.
right?
Yeah.
So it's gonna go with comps, right? But what are you gonna do? What are you gonna be comparing, right? So, I mean, we'll get there, right? At the time being, it's very much like venture capital, right? I mean, you need to have sort of some information to be able to do that valuation.
Yeah, a very interesting point that you raised the point with valuation, actually, because I mean we quite recently developed our own private market valuation multiples that we brought out, and we definitely interfered with the same issues, and that's why we worked on a methodology to do it in an analytical way, and use machine learning. And I think that's actually very interesting how I would say similar approaches here are being established. Let's switch to a very hot topic right now, which is tokenization. This is being applied to everything, I would say, right now: real estate, bonds, private equity, commodities, art, you name it, which will genuinely reach scale first, in your opinion, and which are still mostly a story people tell at conferences like this one here.
I mean, I think we gotta go by the numbers, right? If you see the tokenization market right now, I think it's 26 billions. I mean, last time I checked it, right? I think most of it is treasury. I think there's people are starting to tokenize real estate. There's people are starting to tokenize funds, and you have big names there. You have the Franklin Templetons of the world. You have the Hamilton Lanes of the world, right? BlackRock, obviously. And that's going to drive some kind of adoption, right? Is it going to be quick? I'm not sure, right? I mean, at the end of the day, what these guys are trying to do is to streamline their operations to be able to save costs, right? And now the infrastructure got to go all together, right? I mean, probably before even someone like me invests into a tokenized fund, right? I will need to understand a few things, and that will change jurisdiction by jurisdiction.
Yeah.
Right. So it's super exciting. I think it's exciting. I think people are excited because, you mentioned real estate. People see that they're going to be able to get liquidity out of the market, right? And with some people in this conference, we've been talking about marketplaces. Again, that will take time, right? But it's a first step, and it's a step in the right direction. I think what I'm most interested in, more interested about, is the ability that people are going to have to compose, right? Their token, right? To be able to put as a collateral, to be able to fractionize it, to be able to self-custodize it yourself, right? That's interesting. Again, I think we're still in the very early days.
Yeah, definitely. But we have some developments, and also on the regulation side, as you have mentioned, Europe has MiCA. Does that regulatory clarity give European firms a genuine competitive advantage right now, in your opinion, or is this still too early to tell?
I'll say, look, what the Americans said is that the Europeans always regulate first, and then then we build.
Yeah.
Right.
Yeah.
And that's, to a certain extent, true, I think.
Yeah.
Right.
I would certainly do that.
So, we talk about tokenization. Most of the companies in tokenizations are in the US, right? And they don't have a clear regulatory framework yet,
Yeah.
right? I mean, what gives advantage, right? I mean, obviously regulation is important.
Mm.
Is incentives that you have,
Mhm.
right? I think in Europe we have amazing brains. I mean, right?
Definitely. Yeah. A lot of great researchers also. Yeah.
Great universities, great researchers, right? I mean, you guys have plenty in your portfolio. Now, what an incentive that somebody has to take a risk in Europe? That's a different question, right? Are, from taxes, right? From, building a company, right? Building a company, even if startup in Europe, it's a bit of a pain in the neck, right? Because you hire people. In some countries, you cannot fire them, right? I mean, you need a bit more. You need a bit more fluidity there, right? So I don't think per se, to your question, I don't think per se regulation gives us an advantage. It will help us, but it will help us more if we actually have the right incentives to be able to develop these technologies.
Okay, I mean that's a very clear statement, so to say. We talked about this for regarding institutional adoption. Now you were just on the panel there. I mean, just recently, I think half an hour ago or something like that. I mean, which takeaways here do you have from the panel, and also what was the most interesting insight or the sharpest disagreement? Actually, what would you say?
I think, look, the panel was just to give everybody some framework here and some background. We were talking about institutional adoption, right? What it needs to for banks or family offices to be able to buy digital assets, right? I mean, you guys have venture capital, and that's kind of a different play because at the end of the day, you're investing in companies that are sort of creating tools on Web3, right? For liquid token companies or algorithmic companies or hedge funds, is a different proposition, right? So on the one hand, everybody was talking about infrastructure, right? Do we have the right infrastructure to be able to offer these kind of products to investors? I think the consensus there is that we've gone a long way, right? I mean, you have the custodians that obviously these days are not like 5 years ago when FTX happened, right? I mean, the separation of duties, the assets are not commingling, you know what they're doing, right? And that was good. I think also what people recognize, right, is that there's not a single strategy that is able to address every single market regime. People and the conversations that we have with investors are pretty much the same. People are looking at risk, any return on risk adjusted basis. It's not just I've done 2x, 3x. It's in a year. People don't want that, right? What they want to see is your Sharpe ratio, their Sortino, right? What risks they're actually taking. So investors are getting much more sophisticated, right? But it's still a long way, right? I think it's still, one of the things the industry needs to address is things like, and this we get asked this question many times. It's why sometimes in the asset class became like a casino, right? I mean, just to give you some sense, last year the derivatives market, it was almost at par with the spot market in terms of market cap, right? By the end of the year I think it was 5x, so it's grown exponentially. It's great, right? I mean, in traditional finance, derivatives market are great for price discovery, right? And it helps you to hedge some of that risk. But when you offer 100x leverage, that's not going to help, right? So we're not going to have any regulators that is going to tell us in DeFi you cannot offer 100x. People are going to go to the 100x if they can get it. They're going to liquidate it straight away, and that basically what it means to the industry is that the liquidity drives away. If an event like October last year happened, right, when there was a massive liquidation for the whole, so people start losing trust, right? So I think the industry is going to start regulating itself, and we'll get to a meeting point.
Yeah. Okay. Very interesting. But yeah, I do certainly agree. I mean, let's look in the future now. If you look back at this phase of the industry 5 years from now, what do you think we underestimated actually?
Well, we're probably going to be underestimated what we are building, right? is a regulation, although a lot of people are talking about regulation, right? But it's a bit of a weird market, right? Because it hasn't followed the cycles that the previous cycles have followed. The previous one, where you actually have a lot of liquidity, right? And then you have the L season, and then, right? I think that's not working anymore. We've seen super interesting projects being built now, right? When it's sort of the bear market. And that's very exciting, right? And I think the people that are trying to build this are looking at this with a very different proposition like before, right? Before it was, I just build anything. I get the money. People are going to invest in me. I don't have to give any information. It doesn't matter the structure that I'm using, whether I use a foundation. I just get the money. I can funnel it somewhere else. Whether I add value, it doesn't really matter, right? I mean, somebody else is going to tell me whether I add value or not, right? These days, I think that mentality, we see it, but I think it doesn't fly anymore for institutional investors. And we've seen people are building generally useful, right? That has a purpose, that it solves a problem, which is at the end of the day what you guys also look at, right? And investors like us, right, looking into that too, right? So whether this accrue valuing or the token, what are the incentives that the founders have to be there, to stay there, what is the technology stack they have, right? And what are the right metrics, right? So I think a lot of people are kind of, already looking into other sort of investments. Maybe AI is very hot these days, right?
Yeah.
For the right reasons, right? But people in the blockchain space is still building, right? And there's going to be solutions coming out of that are going to be very meaningful in the next 2 to 5 years.
That sounds really good and really great. Thank you, Ariel, for your insights.
Thank you for having me. Appreciate it.
Guys, for listening actually to the podcast, and start tuning in for the next ones, because we have some stuff that is still being prepared for you guys, so you don't get bored. Like, comment, subscribe, and of course follow what Whale Capital is building in the next few years.
Thank you so much.
Thank you.
Appreciate it. Thank you.
Let's talk about tech, baby. Let's talk about your IP. Let's talk about steel, baby. Let's talk about